Hello, everyone. This is Justin Muscolino again, CEO of Tweezzle, and we're back for another episode of Tweezzle Talk TV. Welcome again, Pam Perdue and Bob Brown. How you guys doing today?
All good over here.
Great, Justin.
All right, great. And thanks for attending today. It's lovely to have you guys back on this weekly spot. So, topic of conversation today. The FDIC recently published the 2021 Risk Report. First question, let's go through a little bit of context and overview of the contents and also who it's pertinent to.
To me, it felt like a lot when I was in undergraduate work and I was faced with a three-part test that had fill-in-the-blank type answers, and I didn't know the answer to one of the questions. So I would spend 20 minutes answering that question anyways and hope for partial credit. And to a certain extent, this report felt that way. It's 80 pages long. I felt they needed to give us an 80-page long report, but it's mostly looking backwards. And in today's world, from a risk perspective, I think we should be looking forwards for the most part. It's good to understand where we came from, but it's much better to look at the threats that are facing us in the future, like liquidity runoff and inflation and natural disasters that could be coming our way, including climate change related activities. And will this pandemic reoccur? And crime, especially in organized crime, now we have national sponsors, national entities that are sponsoring crime. And then just the overall international unrest that's facing us today that could affect the United States in a wide variety of ways. So it was a nice report. It was like a book report type report that told us how 2020 went, but I think most of us know how 2020 went. I think most people are looking for how's 2021 going to go. It was politically correct. I didn't see them questioning anybody or criticizing anybody. So it was a nice report, but I thought it lacked a little in substance.
I would agree with you to the extent that it was very traditional. It contained all the traditional categories, right? It looked at risk through the lens of the CAMELS rating criteria. So for traditional bank models, it was a great synopsis that, like these always are, looking in the rearview mirror, right? What happened? And I think that the world, as you pointed out, Bob, the world is ready for more forecasting and less regurgitation of what already happened. We don't necessarily need the Monday morning quarterbacking because we've got data, we've got immediate access to that data. We have the ability to access other people's data by way of public data. And so, while these are useful, and I will, say here on behalf of our friends at the FDIC, they do this just as much for people who are outside of our industry, right? They've got congressional constituents, they've got other stakeholders who rely on them to give that look in the rearview mirror. But for those of us on the inside of the industry, we desperately need better forecasting of future risks. Like, we can't go back and change any of the risk exposures that we already faced, but a greater emphasis on their view of the unknown unknowns. You mentioned all of these compiled risks. We've got things that are going to happen in the environment that are going to trigger events. We've got things that are going to happen in the cybersecurity threatscape that are going to trigger events. And we just saw very little forward thinking in terms of helping prepare those risk exposures. Now, just because it's not the purpose of the report traditionally, doesn't mean that the agencies couldn't rethink some of their approaches to this type of document, even if it's just putting a section like that in the end.
So you brought up a couple of really good points, what the report doesn't contain, which would be really helpful. Cybersecurity, current events. I guess two questions. One, do you think the report should include, I don't want to say amendments during the course of the year to take into account current events? And what do you really think? Bob, you mentioned a couple of things. Pam, you mentioned a couple as well. But what do you think should be inserted that wasn't?
I'll jump in here real quick because I think most people who are our viewers know that I'm a passionate advocate for consumer protection. And what we're hearing out there in the industry, and now even as I'm in the banker chair, is that the awareness of the risk exposures of consumer protection are greatly aggravated during these times. We're going to see a regulatory response to that. And this report has never traditionally covered those topics. It'll dance around the edges of it when it comes to certain economic condition assessments. But I think that that's one glaring omission from this report that really does not serve what the market needs to know. That they are dazed and confused when it comes to the volumes of regulatory information. And the audience for this report has traditionally been on the safety and soundness side of the house. So they need to consider maybe dipping their toe in that pool a little bit in future reports.
There's a handful of things I'm concerned about. I'm very concerned about the runoff on liquidity on the bank's books. Today we're at historically high levels in terms of liquidity, but most of that money came from stimulus payments to consumers. And there's a good chance that as the economy recovers, we're going to see a just as quick runoff of those deposits. And banks have been attempting to push their loan to deposit ratios up, all of a sudden could catch themselves where they no longer have liquidity, and they've forgotten how to tap sources like the CD market to go ahead and get additional liquidity. I'm also concerned about inflation. I mean, the vast majority of bankers today have never lived in a high inflation environment. I mean, most of us go back to the 1980s when we experienced high inflation. And so and we learned a lot of lessons during the 80s, but I'm afraid most of those lessons have been lost over the last 30, 40 years. I think that this whole issue of climate change has to be addressed. I mean, it's one thing to talk about and repeat the phrase climate change, but it's another to say, how does banks really impact climate change, and how does climate change impact the banks? And we need to figure that out. And publishing plans that say we'll address this by 2050, I don't think that that's really very good. I mean, most of these CEOs that are publishing these plans are in their mid 60s already, and they won't be around to enforce anything that happens in 2050. And then I'm very concerned about the pandemic reoccurring, and I think banks need to plan for that. What happens if we see in the fall a reoccurrence of this pandemic in some new form? And how are we going to react to that? Do we react the same way we did 18 months ago? Or have we learned something from all these activities and we can now have a revised plan as to how we're going to react to a reoccurrence of the pandemic? And then there's this whole international situation. I'm very concerned about what just happened with the Colonial Pipeline and how actors in Russia could shut down the eastern half of the United States from an energy perspective. And apparently from the news reports, the only way we got out of this thing was to pay the ransom. I think that's very dangerous going forward. So back to you, Justin.
So we went through, I think, some deficiencies where the FDIC could definitely benefit from both your input, but let's focus a little bit more on the risks that are contained in the report. There are a few that are very pertinent and front and center. I think CRE was one. What risks really jump out at both of you that feel like we should have this forum as a discussion to talk about?
I'm concerned about the real estate, both commercial and the residential markets today. We've been hiding under some artificial accounting rules that were created under the CARES Act. And some of those risks will never be identified because under the CARES Act, they don't need to mark up these loan modifications as TDRs forever. And so I think that's a serious issue. If you read the postings from other agencies like the CFPB, they're concerned about 2.5 million foreclosures, and they proposed a moratorium on that for the last 4 months of this year, and that's not mentioned in the FDIC report. I mean, it's like they just did not check that off. But if that does not go through, the system cannot handle 2.5 million foreclosures in 4 months.
The other things that I would add there, when you talk about real estate, I mean, there's multiple real estate related issues, like Bob said. There's been this sort of artificial prop up due to accommodations being made proactively, but we also have a very significant housing bubble in terms of the frothiness of the market, the demand for housing, and that demand curve looks a lot like it did before the last Great Recession. So that wasn't talked about in too much depth or detail. And that asset quality, you won't be able to prop it up forever. The issue on commercial real estate, which has been a lingering concern for a while, has really been around, will people use physical workplaces in the same ways that they have in the past? And what does that mean for commercial real estate? What does it mean for the things that went vacant during the pandemic that were equipped a certain way, like restaurant buildings and places where people gathered? So I think there's going to be an impact there. I think also in terms of the shocks to banks' balance sheets, Bob mentioned liquidity earlier, and there would be the temptation to say, well, let's put some of those dollars to work. But as a risk professional, I sit there and go, probably don't rush to do that, because you might need some of that not very far into the future because of these conditions that Bob has also been sharing. The report, when it talks about performance in the industry, there are other competitive factors that the bankers have to consider, like their competition from digital channels and marketplace lenders who have more agile apparatus to address some of these changes and shift more quickly. So the resiliency of traditional banking organizations compared to their mortgage counterparts, compared to their fintech counterparts and marketplace lending counterparts, bank resiliency is much less predictable than for some of those more agile marketplace participants. So we can't forget that we're doing all of this in a competitive environment that often doesn't behave as predictably as traditional bankers would like.
If I was working for a financial institution, what message would you have to say to me about this report? But actually, that's being selfish, only focusing on me. Let's focus on everybody else. What would your message be for the audience out there?
I would say that we need to adapt a more forward-looking approach to our risk management procedures. I was in a bank several years ago that was a Camel's 5 bank, and we spent 3 hours discussing all the elements of risk except for the elephant in the room, that the bank was about to be closed. And I argued with them finally at the end that was the biggest risk facing that bank, was they're about to be closed by the FDIC. But we talked instead about pandemics and foreign terrorists and the real estate market and so on, which are all theoretical in that case versus the practical risks that are facing that bank at that exact moment in time. The bank was closed 3 months later.
And to piggyback off that, Bob, I think we've talked about this in previous discussions of ours. This landscape is so complicated that having the right staff who can deal with this level of complexity is also proving to be a challenge. I'm hearing from friends in the industry, there's a lot of people that are in this window between, too big to just act like a community bank and too small to fit under CFPB supervision. And yet they're going to be in an atmosphere where the compression of the net interest margin is going to require them to look for sources of fee income that they don't have today. And it can be very tempting to go in these directions and chase fee income in creative ways. But we can't forget that somebody is going to be looking over our shoulder, that somebody being the CFPB if we're big enough, our primary regulator if we're smaller. And the detailed scrutiny of those business practices, they're starting to look at the operating models for risk, not just the risk outcomes. They're starting to say, where's your process mapping? How have you mapped your processes to the regulatory requirements? Which systems are involved? So if we don't have the right staff with the right education and level of sophistication to address a more complicated landscape, then we're going to find ourselves turning to more expensive resources to get that risk work done. So I think it's a good time for all financial institutions, all mortgage servicers, anybody who deals with consumers in their business that you've got to be mindful that when there's a downturn, when there's a bubble, when things start to go the wrong way, there's going to be a retreat to whose fault is it except for mine. And so it's not just the regulators that pose a risk either. They're going to be very active plaintiffs' attorneys out looking for the same types of class actions that we saw in the last cycle where we faced this. So I think there's going to be a lot of opportunity for us long in the tooth folks to be called upon just to tap into our memory banks. Because like you said, there are a lot of people in the workforce today that they weren't even born when the S&L crisis happened. So looking at it through the lens of history versus living through it as history, I think we can team up with people to make the future a brighter prospect.
Justin, that brings up one more subject, and that's the subject of staff turnover. In 2020, we saw an artificially low level of staff turnover due to the pandemic and the people's uncertainty that if they left their current employer, they could get employment elsewhere. That is not the case in 2021. There is a plethora of jobs out there. Employers across the country are screaming that they need more employees. And so I think on top of all the additional workload, one of the risks that the banks may have going forward is they may not be able to staff their organizations with the appropriate level of people, both in terms of numbers and experience, because of this pent-up demand. There was a study last week that was published that estimated that turnover this year could exceed 50%.
All right, thank you, Bob, for that insight, and Pam as well. You two have been great, and it's always great to have you on our weekly spot here on Tweezzle Talk TV. Want to thank everybody for joining today. For more great content and other subject matter experts, visit us at tweezzle.com, where you'll find real training and real experiences. Thank you.